So thank you first for inviting me to participate in the deliberations of this webinar and for giving me an opportunity to share some thoughts on what is perhaps an important issue before the country, in the sense that it involves taking or making fundamental decisions about the future of India, keeping in mind the emerging context. As you might have noticed in my topic, I do not say the crisis of the global economy or a global economic crisis, but I'm using the expression crisis of globalization, which means that I'm talking not merely about a cyclical kind of crisis or downturn in the global economy. I'm not necessarily talking only about the immediate effects of the pandemic or the conflict taking place in Ukraine, the impact of these on the global economy. But I'd like to think of this present context as one in which the entire process that we have seen unfolding in the world economy in the last 3 to 4 decades is itself in a state of crisis. And that is the context in which one must be thinking about the prospects of India's economy and how the best is to be achieved as far as our own development path is concerned in the coming days. Now, just to set off the discussion, as all of you would be familiar with, the process of globalization is defined by certain key features. You have, of course, the fundamental underlying reality that across the world you have had liberalization of trade and capital flows starting in the 1980s particularly. The developing countries of the world become part of that process in the 1980s, sometimes coerced by international institutions, sometimes more voluntarily. But whatever it is, it becomes a generalized process. And without the generalization of this liberalization of trade and capital flows, you couldn't think of a process of like globalization. Globalization, by its very nature, involves a global process and involves the entire global economy or most of it participating in that process. It can't be something that is limited to a certain part of the world economy. So liberalization of trade and capital flows was one of the underlying basis for the unfolding of this process of globalization. But of course, it was in a world where movement of people was not equally free. In fact, historically speaking, the restrictions on movements of people during the period of globalization have been perhaps one of the most stringent. Not that there is no movement of people, but the restrictions on that have been to a much greater extent as compared to the trade and capital flows. So people do not necessarily move, but trade, commodities and goods can move, services which can be traded can also move, and capital can move. Now, this particular context has, of course, created conditions in which we have seen two different processes being simultaneously also characteristic of the stage of globalization, a distinct stage in the internationalization of the global economy. One is what has been called financialization, which is simply the process of the growth of financial activities and profit making through financial activities, as opposed to profit making through production. A disproportionately high growth of such financial activities has been also one of the characteristics of the period of globalization. And it has had an international or global dimension insofar as international capital flows, which involves flows which are of a relatively volatile nature, because they can come in and go out quickly from any economy, which is basically for capital flows going into financial markets across the world and moving between financial markets across the world at extremely rapid pace and at very high levels of frequency. That has been one of the important dimensions of the process of globalization, and which has, of course, meant that because we don't have while globalization has not meant that the whole globe becomes one domestic economy, one of the important reasons for that is the fact that different countries have their own different national currencies. So while you have a world in which where you have very many different national currencies. Within those currencies, some currencies, and particularly the US dollar, is the dominant currency used to settle international transactions. This movement of capital across these volatile short-term capital flows across the world's economies have meant that the exchange rates of different national currencies always are subject to the movement of or effects of the movement of such capital flows, and with the possibility of going up and down quite quickly. And we've seen expressions of that in the form of several currency crises in different parts of the world. The one which comes most commonly to people's mind is, of course, the 1997 East Asian crisis. The other aspect of this reality has been that with capital and commodities it themselves being mobile across the world's countries, it is no longer necessary, A, for any production to be located in the country in which the products are to be sold. B, it is not necessary that every stage of the production of a particular commodity be limited to or restricted to one country. So what we have had is the emergence of a globalized production system in which production is spread across or shared across different economies, marked by an extremely rapid increase in the proportion of intermediate products that are traded. And these global chains of production of different commodities tend to be organized in a way as to try and reduce or minimize the cost of production relative to the market that exists in the world. And a lot of that has therefore involved a shift of production, particularly of manufacturing activities, to locations within the world economy which have lower wages than the advanced countries of the world, where most of the world's production was concentrated at the beginning of this particular process. And that particular dominance of a set of countries, which you could call the West or the Triad, if you include Japan within that combination, these are a set of countries which constituted an economic bloc, a political bloc, a military bloc in the world. There is a history as to how that particular thing happened. In the Second World War, many of the members of this bloc were at war with each other, but at least when the process of globalization begins, they constitute a kind of cohesive bloc under the leadership of the United States, which by the beginning of the 90s is the only major power left in the world, with the collapse of the Soviet Union and the breakup of the Soviet Union and the socialist countries in Eastern Europe. With the end of what is called the Cold War, of course, globally, this particular bloc acquired this kind of a political, military kind of dominant position within the world order. It, of course, was reinforced by, of course, the status of the dollar as the world's international currency. And this particular condition was an important aspect of the period of globalization, because while claims have been made that globalization has meant that the world has become flat, it neither began nor has. Currently, are we in a world which is either united or equal? So the Western economies and the Western nations, or the Triad nations, had a dominant position in the world economy, which was part of the architecture which made globalization possible, in the sense that the rules of the game, and in some extent the enforcement of the rules of the game across the world, was also largely the shaping of the rules of the game and the enforcement. In that particular process, a dominant role was played by these nations of the Triad in shaping the conditions for globalization. So it had economic as well as political dimensions, which underwrote, in a sense, this old condition in which globalized production and these global financialization processes unfolded. Now, what was this impact of this on the world economy? If one looks at the specific indicator of growth, Globalization in general, the 3-4 decades of globalization have been a period in which this growth of the world economy as a whole slowed down compared to the growth rates that had been seen in the first 1 or 2 decades after the Second World War had come to an end. Okay, so in this particular figure, you can see that if you look at the average growth levels of the world economy till what is the first oil shock, was in 1973, it was above 5% per annum. But in the whole period of globalization, we have not seen anything remotely close to 5% per annum as the rate of growth of the world economy. And in this entire period of globalization, there's one short period, however, which stands out, which is the 5-year period preceding the 2008 global crisis, or which ended with the 2008 global crisis, which was the one period in which there was some stepping up of the rate of growth of the world economy to above 4% per annum. Not to the levels seen in the 50s and 60s, but higher than what was otherwise the case. But that seems to have ended with the 2008 global crisis. And since then, the rate of growth of the world economy has been even slower than what was the rate preceding that boom, 5-year period of boom before the global crisis. So overall, the growth performance of the world economy as a whole in this period has been less impressive than earlier, and the short period of relatively higher growth has come to an end, and it doesn't look as if since then the world economy has been able to recover its growth situation. A second distinctive outcome of this period of globalization has been what has happened to inequality in the world economy. Okay. So if you look at this graph, which is from the World Inequality Report, you can see the post-1980 period is very different from the pre-1980 period. So a whole more period of almost 1.5 centuries, you have a trend where inequalities in the world between the different countries, between the richest countries and those towards the bottom. This is a comparison based on the top 10% and the bottom 50%. So essentially, the between country inequality is a measure of the kind of divergence that exists as far as per capita incomes are concerned. That was something that post-industrial revolution increased and continued to increase really till up till 1980. But since 1980, this between country inequality has come down, which means that in terms of per capita incomes, the gap between the top countries in the world and the bottom, the top 10%, where countries where the top 10% of the world's population lives and countries where the bottom 50% of the world's population lives, that has come down. That's what is the meaning of the reduction in between country inequality. But within country inequalities have gone in the opposite direction. So declining trend of within country inequality, which was seen for most of the 20th century, that process got reversed after 1980, and within country inequality has actually increased. So these two contrasting trends as far as global inequality. So overall growth has shown a particular trajectory. This captures how that the benefits of that growth come to be distributed across countries and within countries. Now, this reduction in between country inequality essentially reflects the fact that the emerging market or developing countries have grown generally much faster than the advanced economies of the world. And you would notice here that one of the sharpest periods of gap between the emerging economies or developing countries and the advanced economies was the 5-year period of the boom before 2008. So in general, they have grown faster. So the poorer countries have grown faster, but the gap between the two was the highest in that period preceding the 2008 global crisis, which is when you get that sharp dip in the rate of growth. Since then, while the rates of growth recovered after the collapse of 2008, and there were initially expectations that these emerging market economies, which had grown faster, would themselves be able to carry the world economy out of that slump. It turned out that no, even the developing countries, their growth rates also showed a sign of slowing down, particularly in the second decade of the 21st century, even before the COVID pandemic had struck. So the last dip is the COVID effect, and then the recovery that has taken place from that. India has also largely followed that particular pattern. But of course, in the second decade of the 21st century, there was a period in which India seemed to be growing much faster than the rest of the world. But this, in the eyes of many economists, is not a reflection of the truth, of the factual situation, but primarily a result, not necessarily of data manipulation, but the effects of the changed methodology of the new GDP series with 2011-12 as the base year. And other estimates have been made which suggest that instead of 7% per annum, about 4.5% per annum is the likely rate for growth of the Indian economy, even before, till about 2016-17, before demonetization happened. But after demonetization, you see that even in the new GDP series, you see that the rates of growth of the Indian economy were already slipping before the COVID pandemic struck. And in the last year before the COVID pandemic, 2019-20, India's GDP growth was only 3.7% per annum, 3.7%. So there was a distinct picture of slowing down of Indian growth that had happened even before the COVID pandemic struck. So India, in a sense, that fell back in line with the global trend from 2016, after 2016-17, after a brief period in which it, perhaps on account of the new GDP series, seemed to have been charting a path of its own. This recovery that has taken place after the pandemic also, it's because this recovery reflects, of course, the decline that had taken place as a result of the pandemic. And if you see the figures of per capita GDP or per capita private final consumption expenditure in the first half of the year, because for 2022-23, we only have for the first 2 quarters the data available. If you look at that, you find that even 2022-23 is not still significantly greater than in 2019-20. And of course, in the 2 years in between, it was the per capita levels were lower than in 2019-20. So effectively, even after the recovery, you are at levels which essentially reflect pretty low rates of growth in terms of the underlying trend. And what the actual underlying trend is can be perhaps seen by looking at the Q4 or fourth quarter GDP growth rates for the last 3 years, for 2019-20 to 2021-22, because these were the quarters where the GDP levels were less affected by the effects of the pandemic. So you don't have a dip and then a recovery and an exaggerated rate of growth coming in 1 quarter, because in the previous quarter the previous year, the same quarter, you had a sharp dip. So those effects were minimal, and the Q4 GDP growth rate therefore may actually reflect what the underlying trend of India's GDP growth is. And the 2022-23 first 2 quarters data are also indicating that perhaps this is likely to be the underlying trend of the growth of the Indian economy. So India also reflects the larger global pattern of slowing down of growth in the second half of the 21st century, which has been further aggravated by the effects of the pandemic. But while this difference in growth, and also the fact that developing countries in general have had higher rates of population growth than the advanced economies of the triad, this difference in growth, and in particular in the first decade of the 21st century, That particular difference in rates of growth led to quite a significant shift in the geography of world production. So the advanced economies of the world, which at the beginning of the period of globalization accounted for almost more than 3/4 of the world's GDP, their share came down to just a little over half. And while developing countries or emerging economies' share has increased, much of that increase is actually in Asia. And within Asia, of course, China is the most significant contributor to that. But India's trend is also similar, that India's share in world GDP increased during this period of globalization, partly driven by increases in population and partly driven by faster rate of growth of per capita income as compared to the advanced economies. However, one should not exaggerate the effects of this shift, because if you look at the world 30 years apart, 1991 and 2021, and you look at where the world's high-income economies are located, which are the dark green ones in this, the lower one is 1991, the upper half of this figure is 2021. You can see that the dark green parts of the world are not very different in 2021 than from what they were in 1991. What you do see, however, is fairly significant part of the other countries in the world moving from low income to lower middle income status, or from lower middle income to upper middle income status. So that's the process that has happened. It has not yet meant that the world has become equal. And the geographical pattern of that inequality also has not drastically changed when you look at it in per capita terms. But in terms of overall GDP shares, there is a significant shift that has taken place. And how much difference that per capita income levels are illustrated here. And even if you use not the per capita income in current dollars, but per capita income in purchasing power parity terms, which are more favorable to developing countries and particularly favorable to India, even then you can see that there is still a long distance that separates the high-income countries from the other countries of the world. And of course, India is also still in the bottom half of the lower middle income category. So the catching up process, in a sense, is still very, very far away. So if you're thinking of India achieving developed country status, that's still a very, very long way away. What India has also reflected, however, in this period is this process of increased inequality. So one side of the process is per capita incomes increasing faster in the poorer countries. So India is part of that process. It's also part of the other process, which is increasing within country inequality. And same pattern happens, that is during the period of globalization, and India also becomes part of that process, particularly prominently after 1991. You have a significant increase in inequality, which with top 10% of the population cornering almost 57% of the national income by the current position, that's the extent to which it's increased. So there's a very heavy concentration of the incomes which are being captured by the per capita income growth. So the per capita income growth trend, as far as India is concerned, is reflecting more what has happened to the incomes of the top 10%, and much less what has happened to the incomes of the remaining 90%, and particularly the bottom 50% of the population. The process that we have actually seen is one in which, till the beginning of the 90s, almost 2/3 of the employment in India was still in the agricultural sector. Agriculture has not been able to sustain significant part of the population anymore after 1991, and you've seen a significant exodus from agriculture after that. Manufacturing has not been particularly important in the absorption of the people coming out of agriculture. It is construction, and particularly before 2010-11, which absorbed a significant part of that decline in agricultural employment, and the rest went towards services. But if you look at, this is only telling you what is the distribution of the actual employment. But one of the important features of what has happened in the Indian case is a decline in the proportion of the population which is actually employed. And we have, if you see this particular table, one of the largest segments of the, the lowest proportion of population which is employed in the world. And even if you compare India with not just the advanced economies, but even Asian peers, most of them, the proportion of the Indian population which is employed is very high. Okay, is very low. If you look at the difference between India and China, India is 46%, China is over 67%. This is a population above the age of 15. So what has happened is actually a much smaller proportion of the population is being employed in activities which earn them something. They may be doing other things, and a lot of them do other things to help their household sustain, particularly women who constitute the bulk of this population which is not employed. The other aspect of this is, of course, that but what essentially you have is a reinforcement of a labor surplus situation in India, which is reflected in part on the high level of informality in the employment proportion in India, which is also the highest in the world. And the general situation then becomes that the wages that you can get for any kind of labor or returns to labor tend to become very low, and that's what has underlaid this increased inequality, that when you have a permanent labor surplus situation, people come out of agriculture, but there isn't sufficient non-agricultural employment. You have a large labor surplus in the economy acting as a depressing force on the returns to labor. And you can see that across the board, whether you look at agriculture, factory workers, different kinds of employees, average earnings of most Indians, and 90% of Indians primarily have to depend on labor incomes for their income status depends on the returns to labor, because the asset ownership is also concentrated in the top 10%. And of course, you can either make your income, get your share in the income from asset ownership or from labor. The labor share has tended to come down because of this fact that this permanent depressing income and wage depressing tendency comes from the fact that you have a extremely large reservoir of surplus labor, which is simply unable to find employment. Now, one of the important aspects of this shift in the world's production structure is in the geography of world production has been what has happened in the case of manufacturing. And again, that's something that most sharply happens in the 21st century. So not only GDP, but manufacturing value-added production generation was also concentrated in the advanced economies of the world, in the triad economies, even at the beginning of this century. But that share has come down drastically. And again, you see a shift towards Asia other than Japan, that being the major center towards which this shifting geography of world production, the globalized production systems have met as this shift in towards Asia. Again, China, of course, figures very prominently in this particular shift, but it is not limited to China. It's just China is such a bigger story as compared to everyone else. India also participates in that particular process. But if you look at the level to which this industrialization has been achieved, when seen in terms of per capita manufacturing value added, then you see that despite this shift that has happened, except for East Asia, excluding Japan and China, which is basically your South Korea, Taiwan, etc. Except for these few countries, none of the others have come close to matching the per capita levels of industrialization achieved in the advanced economies of the world. And as far as India and Southern Asia are concerned, it is amongst the lowest in the world that you can find. Only Africa has a comparable level of industrial development as in India. So India and South Asia remain, in per capita terms, amongst the least industrialized centers of the world economy, despite this increase in share. And you can see that the increase in the share is, of course, the extent of that increase in the second decade of the 21st century is much less than in what happened in the first decade, when that high growth of the world economy took place. And you can see that while there is this shift away from the advanced economies, it is not uniform across different countries. It is again primarily an Asian story. Latin America and Africa, their share is actually moving in the other direction. And when you particularly compare, so neither do they have significant increase in per capita levels of industrialization, nor do they have increase in their share in world manufacturing value added, commensurate with their share in the world population. So it's not a uniform story of shift from all developed countries to all developing countries. It is a primarily Asian-centered process, and within Asia, it is East and Southeast Asia, which is the accounts for the bulk of this global shift that has taken place in world manufacturing production. Okay. But if you look at the world economy as a whole, this has been a period in which the world economy has been deindustrializing, where the importance of manufacturing in total value addition has been on the decline. It began before this onset of globalization, and it has continued down that particular road. And if you look at India within this story, India was already amongst the much less industrialized countries of the world. So its share of manufacturing in its total value added was still much lower than in the what was the average for the world. But it hasn't meant that India is now on a chart of increasing share of manufacturing in value added. Instead, India is following the global trend of deindustrializing, but from a much lower level of industrialization. This is what is referred to as premature deindustrialization, something that is afflicting several countries in the world. Almost all parts of the world are now experiencing this particular process of deindustrialization. And in the second decade of the 21st century, the effects of this appear very sharply in the Indian case, in the form of an extremely slow rate of growth of industrial production that we are seeing in the second decade, much before any effect of COVID or even demonetization expressed itself. We are experiencing almost a stagnation in industrial production in the second decade of the 21st century. If you look at trade, again, you see that not just as the world rate of growth slowed down in the second decade, you also have the process of rising importance of trade to the world economy, also reversing in the second decade. One of the indicators that is used to describe a process that some people now call deglobalization. In the Indian case, you see also such a reversal. In the Indian case, the rise and the fall are both far more dramatic than for the world as a whole. So in the previous decade, India's trade became much more important relative to her domestic production and grew at a very sharp rate. But in the second decade, it's the exact opposite that has happened, that the significance of trade for relative to domestic production has been on the decline, both exports as well as imports. If you look at the capital flow story of the world, there too you see that the second decade of the 21st century, the very high rates of growth of capital flows across the world, international capital flows, which is captured in the form of increase in ownership of assets by any country's citizens acquiring assets in other countries. So the growth of foreign ownership of assets, which was very rapid till the first decade of the 21st century, has slowed down considerably. And even the portfolio capital flows, which is the feature of financialization, even that is something that has slowed down along with the FDI in the second decade of the 21st. A significant sharp deceleration in the growth of capital flows, which again is reinforcing that whole idea that we are now in a phase of deglobalization rather than globalization. In the Indian case, the effects of all of these you can see in the fact that the nature of interaction with the world economy seems to be changing quite drastically. So in this figure, the dashed lines show you the trends in the dollar values of different international transactions, exports, imports, foreign investment flows. Taking the first year, which is 2011-12, as 100 as the base year. It's an index. We are comparing the indices. If you look at the indexes for the previous decade, taking 2001-2 as the base year, then what happened is shown by the bold lines, solid lines. You can see that the previous decade was one in which India's international interaction expanded considerably, large capital flows, high growth of both exports as well as imports. But the second decade has been one in which these have all stagnated. So there is clearly something. India is also reflecting the process of changes that are taking place in the world economy. Now, that should have put into context the Indian condition or situation. In India, the trade deficit, the gap between exports and imports, is something that has always, for the large part of the period of India's insertion into globalization, has been much larger than existed in the past. So India's clearly has not been a process of export-led growth, because as far as trade is concerned, the net effect of demand is negative because we are importing more than we're exporting. So goods, this is true. It's in the case of services, this has been a slightly different story. But despite the case of services, where particularly because of IT services, we have a surplus. We also have remittances from Indians abroad contributing to the large surplus in invisibles, which has kept the current account deficit somewhat in check. But if you see in India's case, the high period of high growth was marked by a consistent decline in the current account position, which is in contrast to what was happening for most of the developing countries, which were actually turning into capital exporters on a large scale during that particular period. So even if the current account deficits and the trade deficits have come down in the second decade, what should put it into context is this is not that India is now turning towards export-led growth. Actually, everything is stagnating, and it is depressed growth rather than, which is explaining why the current account situation improved, particularly towards the second half of the second decade. Now, throughout this period, of course, India has been, because of its current account deficit, has been dependent on external flows to cover its deficit and to build its foreign exchange reserves. But what is the difference in the period of globalization is, so as you can see, the trade balance has been much higher. The deficit has been much greater than ever before. But the capital flows that have come in, or the forms in which foreign flows have come in, that is what is distinct in the period of globalization, that it is largely foreign investment, both portfolio as well as direct, that accounts for the bulk of the flows to India in the period of globalization, unlike in the past when debt or foreign aid played an important part. And but the implications of the other side of India's trade deficit is that essentially it means that in the production of goods, and that means primarily manufacturing, India is not sufficiently competitive in a sufficiently large range of products to be able to generate an export surplus. Reflection of that is that FDI that has come into India in the case of manufacturing is not export-oriented FDI. But where it tends to, so even export surpluses are generated by FDI in services and not FDI in manufacturing. So FDI in manufacturing adds to the foreign exchange burden rather than easing it by generating exports based on production located in India. Services exports have somewhat compensated for that, but overall, FDI in India that has come in has generated more imports than exports. So therefore, the Indian dependence on relatively volatile financial flows or portfolio flows structurally has been that much greater during this period of globalization. One other very important feature we see of the Indian economy in the second decade of the 21st century is a reversal again of a very sharp increase in India's investment ratio that was observed in the period leading up to the global crisis, and then a consistent trend of decline in the investment ratio, which is indicating both a reduction in investment in machinery and equipment, as well as a significant slowing down in the growth of construction, the two components that make up fixed capital formation. So you're seeing a consistent declining trend of a kind that we have never seen before. It's been prolonged enough to be accepted as a significant enough tendency of the Indian economy, where the investment ratio is actually falling. Now, essentially, what this is perhaps reflecting is the fact that activities which could absorb large quantums of investment, things like manufacturing in particular, are facing severe demand constraints on account of the fact that if you don't have export surpluses, and if you don't have you have wage and income depression of such a large section of the population, then of course you are in a condition where demand constraints are likely, and it is the onset of that problem that you, or the onset of this declining investment ratio is perhaps a reflection of this, because it reflects an overall trend of stagnation in Indian investment, including of and led by private corporate investment, which led the growth as well as the decline in the investment ratio. So, and the fact that you are inserted into the global economy and inserted in a way in which you are dependent on relatively volatile capital flows to cover your deficit has meant, of course, that India has been facing the problem of needs to kind of follow fiscally conservative policies to a much greater extent than economies which are able to generate an export surplus and therefore are less threatened by capital flows as far as the value of their currencies are concerned. And so we've seen public expenditure being kind of kept in check throughout the period of globalization, and the importance of the fiscal deficit and reducing the fiscal deficit has always had a priority in fiscal policy. But tax to GDP ratio is something that increased only for a brief period in India during the 5-year boom before the 2008 global crisis. Otherwise, tax to GDP ratio is also tending to stagnate, and therefore expenditure is something that tends to follow what's happening in taxes because of and the fiscal deficit. So in the second decade of the 21st century, we have been trying to recover the fiscal deficit from what was the position that it had reached because of the fiscal stimulus after the 2008 global crisis. So when the rest of the economy is showing a slowing down tendencies, loss of economic momentum, fiscal policy has also been contributing to that, because it has been all about trying to keep expenditure in check rather than stepping up expenditure. So to sum up then this story, and to then come to the question of what about the future. So on the one hand, one can say that the globalization process is facing a crisis which has two sides to it. There's or two components to it. One is, of course, that the post-2008, it appears that the world economy has not been able to generate the impetus for expansion of the kind that it had till 2008. That is, the whole set of conditions that emerged was not sufficient to push the world economy towards higher growth. Even though there was a shift in the world economy towards the developing countries, and their weight in the world economy increased, that shift seems to have not created conditions where they could autonomously generate impetuses for expansion of the world economy. The pre-2008 growth was driven by the US. Once the US, but what seems to have happened is that the changed geography of world production has meant that neither is the US in a position to drive the world economy, but the countries of the world whose weight in the world economy has increased, they also do not appear to have acquired, as a result, the capacity to drive the world economy. So the changed geography of production has not meant that the locus of driving the world economy has completely shifted away from the advanced economies to the developing countries, particularly in Asia. Okay. But what it seems to have done is to increase geopolitical tensions, because now the potential Western dominance of the world, the changed geography of world production has contributed to some shifts in that, and the tensions that have arisen as a result of that have also started unfolding now, and perhaps the Ukraine conflict is also one expression of that. And that particular conflict then sets off a dynamic of its own, where the political responses to this underlying economic shift are also creating tendencies where the conditions in which globalization take place are getting ruptured and broken. And partitions and walls are coming up within the world economy. And a lot of the global trade and capital flows have to now find ways around those walls rather than conditions where free flow of goods and capital can take place. And the effects of some of this we saw during the pandemic. So it's become a divided world. It's still an unequal world, and it's a divided world, and that may have affected, that has also been seen in the ability to respond to something like the pandemic was also constrained by these features of the world. As far as India is concerned, India's integration into the process of globalization has meant, of course, that India could grow, has been able to grow at rates, reasonably high rates, and followed other, been a prominent member of the developing world, which has grown during this particular period. But that process of insertion has not been able to create the conditions for industrialization in India, or industrial development-led growth. What you in fact have seen is a growth process dominated by services and construction. And that particular growth trajectory, so growth has happened, but not industry-dominated growth, because neither external markets nor domestic markets have been able to sustain that growth. You have not been able to find, so income inequalities have constrained the demand growth. You've not found a substitute in exports, and India's fiscal policy measures have been constrained in their ability to change this condition, either by in the form of public expenditure-based stepping up of demand, or to redistribute the income in a way where a more broad-based domestic market could actually emerge. So even in the better period of globalization, there were these limitations to the process of Indian growth, where growth happened, but it was difficult to address issues of employment, issues of development in this, and policy space was constrained in terms of addressing these aspects once India was inserted into the global economy. But now that process is also showing signs of losing momentum. This happened before the pandemic, and the pandemic and of course the present global situation also means that the conditions are becoming more serious. And with the whole process of globalization itself in crisis, and perhaps likely to remain in that condition for a fairly long period of time, because we are seeing shifts in the world economy and in world politics which have not yet settled down into some new order. It may take a long time, and what direction and precisely what form it will take is something that is uncertain. In that condition, given that in better days, the insertion with the global economy produced some positive effects, but also came with several negative effects as far as India's development trajectory is concerned. Once you enter this phase of crisis of globalization, it is an important question to ask whether India's future lies in a similar assertion, or does India's future lie in opting for a more autonomous path of development in which you have to and also become more capable of addressing the internal inequalities that have grown over the last 30 years. Thank you.